There was a huge announcement last week in the mortgage world. It has to do with interest rates and how they're going to change. So we're going to cover that now. If you haven't seen it already, just watch. It only takes a couple minutes, but just so you understand kind of what's going on and what's coming up. So first thing we need to do is get an understanding and definitions on things like rates and points. So most people are pretty familiar with what points are. We're going to cover it here. Points are basically fees that are paid upfront in exchange for getting a lower interest rate. 1 point equals 1% of the loan amount. So on a $300,000 loan, if someone pays 1 point on that loan, they're paying $3,000 in higher closing costs. It's not always a full percent. It could be a fraction of a percent, could be a 1/4%, multiple points, but it's not always expressed as one single point. On average, when you pay 1 point, that equals about a 1/4% lower interest rate. This isn't true all the time, but that's generally a good average to go by. So the reason people are paying points is to be able to get a reduced interest rate. Right here, it says that on this assumption, if someone pays 1 point on a $300,000 loan, they get a 0.25% lower interest rate. It takes about 62 months of getting that lower interest rate and the savings you get over 62 months to equal the $3,000 that you pay up front. So the payback is a little over 5 years. When we're pricing a loan and giving someone an interest rate quote, there's several factors that come into play. So we're going to look at that whole scenario, and Fannie Mae, this is their little logo here. Fannie Mae has something called loan level price adjustments. And this is how we figure out what someone's interest rate is that they're eligible for. So you can see it's got credit scores, it's got down payments, it's got other factors here. There's more in addition to this, but this is just what I can fit on one screen. But for example, if you have someone with a 720 credit score, putting 20% down, buying a condo, we're going to look at this sheet and see in the 720 range, they'd be right here. They put 20% down, so that puts them right over here. So right here, they're being charged 0.75 points to get whatever the current market rate is that day. Now you come down here, there's a condo, and the condo has a fee adjustment with it here also. So you can see where that fee adjustment is here. So you add up all these adjustments here, you add this one here. If there's any other ones that apply, you're going to add up all these and come up with a final number, a total of how many points are being applied to get that to get that daily interest rate. Now, a lot of times what happens is instead of charging the points, you raise the interest rate to absorb those points into the rate. If there's 2 points and adjustments that are being paid here, if we say on average it's a quarter percent lower interest rate for 1 point, paying a point, if you raise the interest rate, say 0.5%, you can basically wipe out and eliminate those points from being paid up front. So in this case, for example, if the daily rate was 6% and you had to absorb 2 points into it, if you raise the rate to like 6.5%, that would be the rate for 0 points. So the big change that came out last week, Fannie Mae announced that they are changing this grid here, and you can see these numbers here are quite a bit higher. A couple big changes that jumped out. These numbers are higher. They added some top tiers to the credit rating. It used to be before that over a 740 credit score got you pretty much the top tier pricing from Fannie Mae. Now they have two other buckets higher than 740. You can see 760 to 779 and over 780. So now, if you really want the top tier pricing and best interest rates, you really got to have over a 780 score. The other big change that I saw is that now they're factoring in your DTI, your debt to income ratio. So if you have a DTI over 40%, and you have a down payment that's less than 40%, you're going to see hits on that. And so it goes all the way across here. This next chart kind of shows the difference between the two, where red are areas and buckets, I call them buckets, where things got worse. Green are buckets where things kind of got better. So you can see here, people that have pretty good to good credit scores with let's see, 30% down up to 5% down, kind of in this pocket here. These people in this category, the pricing got worse on the rates, or they will be getting worse. people over here with good credit and lower down payments, and then people here with lower credit maybe are getting a little bit better pricing. The kind of funny thing about this is that lower down payments, lower credit scores have the best pricing adjustments. The problem with these is that when we run these through Fannie Mae, rarely do we get approvals on these. So I don't even know that, someone with a 640 credit score putting 3% down probably isn't going to be eligible anyway. So this doesn't really make a whole lot of sense. So these are all changes that are coming very quickly. On the announcement last week, they said these are for loans that are delivered to Fannie Mae on or after May 1st of this year. So that doesn't mean this goes into effect May 1st, because it takes about 30 days for a closed loan to get securitized and packaged and sold to Fannie Mae. So you got to back it up about 30 days. But those are 30 days from when it closed. But when is that closed loan? When was that locked? Probably 30 days before that. So really, if it's May 1st, you got to back up to April 1st before that loan starts to get securitized. And then you back up another 30 days before that when that loan is originally locked, which is probably March 1st. So I would expect this to go into effect probably early March, maybe end of February. There's no set timeline because every lender, every investor prices things differently. They have their own timelines they follow, but look for these changes probably the end of February, early March, and get your people aware, let them know this is coming. If you have people on the fence right now, they may want to consider moving on this quickly, especially if they're in this category here where they would be more negatively affected. But yeah, this is coming. These are for loans that have loan terms greater than 15 years. So borrowers that are doing 15-year loans will not be impacted by this. So maybe that's an opportunity for people to look for 15-year loans instead of 30-year or 20-year. Another option is FHA. This does not apply to FHA loans. Another option is VA, because VA doesn't have these adjustments, or USDA. So, and one last thing, this is Fannie Mae, their release from last week. Freddie Mac is the other partner that does conventional loans. They haven't released anything yet, but typically when anything big comes out like this from one of the agencies, the other one is soon to follow. So hope this helps. This was big news that came out last week. Just want to share it with you so you know what's out there and what the scoop is with real estate. And particularly with mortgage. So if you have any questions, please feel free to reach out. Let me know. I'll see if I can help any way that I can. Okay. Thanks a lot. I hope you enjoyed, and let me know again if you have any questions.